Hi, Map here. This is a video here on Arkk. IV rank is showing at 62%, so it's a very nice ETF to sell premium in. Let me pull up the Market Smith chart. Here's the chart. Arkk Innovation ETF, $133 per share. They basically focus investing in stocks of companies engaged in life science, robotic, energy storage, and social media. So it is a pretty expensive stock. It's $133. There is some decent premium in here. So if you wanted to do a naked strategy here, like sell a put, which might be a little bit heavy, because if you do one put on this stock and you get assigned, you're talking about 133. So we're basically remember, one contract is 100 shares. So if you sell one put, so you're looking at 100 times 133. So you need $13,300 if the stock were to fall down to your strike price. Let's say if you sold the 125 put, for example. I haven't even looked at the option chain. You plan on taking assignment if it were to fall to you. So you're looking at about 12.5. So you need 12,500. So for people that don't have that kind of money, you can always do a put credit spread. So I'm in the Tasty Work platform, and this is ARKK. You would select a strategy here, right? And then you would go to vertical, the first strategy, sell, put, go. So you typically you want to go out about 45 days. These options have 20 days, so I'm gonna roll out the expiration till we got about, okay, so that it would be the monthly, okay, it would be the February 19th monthly option chain. So what you can do here, try and formulate a plan where you collect a third of the width and have a high probability of a profit. So you can do all kinds of trades depending on your budget. Now let me look at here a second. Let me switch back to the table and see what kind of strikes we have on this. So let's go to February. So it seems like they have dollar wide strikes. So this is pretty cool. So I'm gonna do a dollar wide strike, and then I'll do maybe a $3 and $5 to show you the example of what you can do here with the limited budget. So let's go back to the table, because I like this app because of illustration purposes. So let's just go down to 125, 120. All right. So basically, looking at here, this is a $5 spread. Okay, so you're selling the 125 put and you're buying the 120 put for protection. So this is a defined risk trade. This is a $5 wide spread, and your max profit, you're going to be collecting a credit now here of $140. And the max loss is $360, which they both equal $500. If you look under the ticker symbol, Arkk, and then you got vertical, and then you got POP. POP stands for probability of profit. It's 63%. Now, if you want to get further out, let's say you want a higher probability of profit, you can always go to 120, 115, which this seems pretty good. I remember the bid ask might be off because the market's closed. So I'm just going based on what the option chain has right now, and just showing you illustration purposes of what you can do in this trade, or in this underlying, if you wanted to be engaged and part of this ETF. So this trade right here, selling the 120, buying the 115, has a 71% probability of profit. You're collecting $1.38, and your max loss is $362. Now you say, oh, well, Map, that's a high loss to risk. But remember, you're at 71% probability of profit. So that's the beauty of options. You can formulate these strategies where the probability of profits are greater than 70%. And they're pretty accurate. And when you're selling options, you can always roll and defend your position for more credits. I'm not going to get into that in this video. And if you have any doubts, you can always YouTube rolling options, and I always recommend people go to Tasty Trade, where they have archives and a lot of great content where you can learn. So that's one trade. That's a $500 trade buying power that you need. So if you wanted to do, let's say, just a dollar wide, you can do a dollar wide. Here you would only be collecting $25 and risking 75, and you have a 69 probability of profit. Now, if you wanted to go a little bit closer, let's say 122 and 121 or 120, so you could play with it to what your comfort zone is, right? And trying to make the risk worth the credit. So here's a decent one. You're collecting $35 and you're risking 65. It's a dollar wide spread. It's $100 this spread, and you have a 63 probability of profit out in February with 55 days to go. You can also spread it out, maybe do it a little bit wider. Let's say $300. So 64 probability of profit. You collect $100 and you risk $200. So this is a put credit spread. It's not a naked spread. You're not selling a put naked and taking the risk of getting 100 shares assigned to you, because remember, one contract is 100 shares. That's a naked put. Some people don't have that kind of money. But if you want to be engaged in this ETF, it has a nice IV rank of 62, so you can get further away from the $133 stock price and formulate something that's in your budget while collecting a good credit. I hope you liked the video. Please like it, share it, subscribe, comment below. I'm here to help. You can comment. We have open dialogue here on the channel. And I'll help you formulate any trades, or, just talk about trading, because trading can sometimes be a little bit on the lonely side. Well, Merry Christmas, Happy Holidays, and hope to talk to you soon.